$53. On March 23, 2020, as the world was grinding to a halt, that was the price for a single barrel of West Texas Intermediate crude oil. That very same day, the S&P 500 hit rock bottom, a seemingly endless pit of pandemic-fueled fear. Now, let's fast forward. Just a few years later, oil prices had rocketed past $130 a barrel, and the stock market, it hadn't just recovered, it had more than doubled in value. Wait a second, that flies in the face of everything we've been taught. Aren't sky-high prices at the gas pump supposed to be a wrecking ball for the economy and a surefire rally killer for stocks? Today, we're going to pop the hood on that assumption and show you precisely why the opposite can be true. We'll explore how the so-called smart money doesn't just survive these moments, but actually rides the wave instead of getting run over by it. Stick around, because by the end of this, you'll have the toolkit to spot whether the next major oil spike is a poison pill for your portfolio, or its secret, high-octane turbo boost. We've all heard the familiar, simple story. When oil prices go up, everything gets more expensive. Corporate costs for manufacturing and shipping swell. Consumer wallets get pinched at the pump, and discretionary spending dries up. The logical conclusion: stocks go down. And to be fair, sometimes that narrative is perfectly accurate. History gives us stark examples. The 1973 oil embargo and the 1990 invasion of Kuwait caused prices to practically double overnight. This wasn't a sign of a healthy economy. It was a supply shock. It crushed corporate profit margins, slammed the brakes on economic growth, and helped shove the economy into a painful reverse. But that's only half the story. History also serves up a completely different scenario: the demand-led rally. Think of the dot-com boom in 1999 or the synchronized global recovery in 2017. In those cases, rising crude prices weren't a signal of crisis, but a confirmation that the global economy was firing on all cylinders and demanding more fuel to grow. It's the same upward trending price chart, but it's powered by a totally different engine. Our job, as informed investors, is to tell the difference between a market driven by supply-side panic and one enjoying demand-side euphoria. Here's a powerful way to reframe your thinking. Look at the price of oil not as a cost, but as the world's most crucial real-time growth meter. Long before governments release their official, backward-looking GDP numbers, the demand for crude oil tells you what's happening on the ground right now. When factories are humming, cargo planes are full, and highways are jammed with commuters, the demand for oil, diesel, and jet fuel ticks upward. This is the first flicker of economic acceleration. Equity analysts and savvy investors watch that flicker like hawks. If oil prices are rising because the global economy is throwing a party, then the entire forecast changes. The complex cash flow models for industrial giants, airline carriers, and even consumer discretionary companies that deliver your late-night pizza all get a significant upgrade. The market, which is always trying to price in the future, reacts to that optimism with lightning speed. Take the period from June 2020 to July 2021. As the world began to dream of reopening, oil rebounded. In response, the energy sector of the S&P 500 leaped by an astonishing 100%. While the broader market itself posted a very healthy 35% gain, it was the same indicator, rising oil, but with a completely different driver. Resurgent demand, not a sudden supply embargo. A spike in oil prices isn't a blunt hammer that hits every stock equally. It's a finely tuned surgical scalpel that creates distinct winners and losers. For every extra dollar that a barrel of oil costs, a behemoth like Chevron sees its annual cash flow increase by roughly $1 billion. This windfall extends across the entire hydrocarbon value chain, from the refiners who process the crude and the pipeline owners who transport it, to even the obscure companies that supply the fracking sand. Their profit margins get fatter. On the other side of the ledger, airlines, shipping companies, and any business that relies on a massive diesel fleet feels an immediate and painful squeeze as their single largest operating cost explodes. So what's the net effect on a major index like the S&P 500? This is where the math gets interesting. In 2022, the energy sector made up only about 5% of the index's total value. Yet, it was responsible for a hugely disproportionate 11% of the index's total earnings growth that year. Because the S&P 500 is a market cap-weighted benchmark, the soaring profits of a few massive energy giants can have a much larger positive impact than the struggles of several smaller airline companies. When oil doubles because of booming demand, the winner's gains simply outweigh the loser's pains. This is the channel that makes most investors start sweating. Rising crude prices directly lift the Consumer Price Index, or CPI, which is the market's main inflation gauge. Higher inflation forces bond yields to spike, and as yields on safe government bonds go up, the future profits of high-growth tech stocks suddenly look less attractive, making them look toxic. But this relationship isn't set in stone. It bends depending on the economic environment. Consider a scenario like 2021, where wages are also rising and robust companies have enough pricing power to pass their higher energy and material costs directly onto the consumer. In this environment, corporate earnings can actually outrun the drag from higher interest rates. The Federal Reserve may still be hiking rates to cool things down, but stocks can continue to climb because their nominal profits are racing ahead of the real, inflation-adjusted yields. Now, flip the script to the summer of 2008. Oil surged to an eye-watering $145 a barrel, but this time, wages were stagnant and consumers were tapped out. The Fed, already trying to manage a subprime credit bubble, was in no position to help. The result was a catastrophe. Context, as always, is everything. Ultimately, oil and equities share one deep-seated phobia: extreme uncertainty. When the VIX, Wall Street's so-called fear gauge, spikes, it signals panic. In that environment, institutional funds don't ask questions, they just sell. They dump anything perceived as carrying risk, which includes crude oil futures, high-flying tech shares, and junk bonds, all at the same time. This is exactly what happened in March of 2020. As panic consumed the globe, oil famously crashed to a mind-bending negative $37 a barrel. The S&P 500 plunged 34% in a single month, and the statistical correlation between the two assets spiked to 0.8, meaning they moved in near-perfect, terrifying lockstep. But once the initial panic fades and a semblance of calm returns, the entire dynamic can flip. The fear of uncertainty is replaced by trades based on recovery and reflation, where rising oil and rising stocks are seen as two sides of the same coin. Bet on a return to growth. You can get a sense of which regime we're in by watching the VIX in combination with data on net long crude futures. Together, these indicators are like a live feed telling you whether the market is in a panic-driven risk-off mode or a growth-driven risk-on mode. The impact of an oil price shock is not distributed evenly across the globe. A $10 jump in the price of Brent crude might nudge the annual inflation rate in the US up by 0.3%. But for a major energy importer like India, that same price jump can translate into a much more painful 0.7% increase in inflation. Then you have a country like Norway, a major oil exporter. For them, higher prices mean a massive fiscal windfall, a bonus to government coffers worth as much as 1% of their entire GDP. Analysis of MSCI data from 2010 to 2023 shows this divergence in stark terms. Every sustained 50% surge in oil prices, on average, handed Norway's stock market benchmark a 12% gain while saddling India's Nifty index with an 8% loss. For global investors using ETFs, this creates an opportunity to exploit the spread with a simple, long-short strategy. Even domestic investors can use this logic to tilt their portfolios. You can overweight U.S. shale producers, underweight airlines and truckers, or buy the energy sector ETF, XLE, when forward-looking indicators like global PMI and refinery profit margins, known as crack spreads, are pointing up. Let's walk through the post-COVID recovery as a perfect case study. Step 1. In March 2020, we had a classic demand shock. The world locked down, travel ceased, and the price of oil crashed as equities cratered right alongside it. Step 2. By April and May, central banks and governments responded with an unprecedented wave of liquidity and stimulus checks, essentially carpet-bombing the economy with cash. Mobility, data, and energy usage stats began to bottom out. Step 3. From June through December of 2020, Brent crude climbed steadily from $40 to $52 a barrel. This wasn't based on current activity, but on the powerful hope of a global reopening. The energy ETF, XLE, doubled, and the S&P 500 tacked on 30%. Step 4. Throughout 2021, a geopolitical risk premium began to creep back into the price, pushing Brent crude to $77. Yet, blowout earnings reports from tech, consumer staples, and energy companies alike propelled the S&P to new record highs. The dominant narrative was clear. This was a synchronized global recovery, not a 1970s-style supply embargo. Investors who correctly diagnosed this and bought the energy dip in 2020 rode a massive 150% wave over the next 12 months. So, how do you know when a rising oil price is signaling danger instead of opportunity? Watch for a combination of these three classic warning signs. The price of Brent crude rips more than 20% in a single month, but at the same time, forward-looking economic indicators like global manufacturing PMIs are sitting still or falling. This suggests the price spike is driven by a sudden supply disruption, not healthy demand. The price for oil delivered next month leaps far above the price for oil delivered 3 or 6 months from now. This market structure, called steep backwardation, signals extreme immediate scarcity and can lead to hoarding, creating a speculative bubble. Financial data shows that speculative net long positions are hitting historic extremes at the exact same time that consumer sentiment surveys are tanking. This dangerous combination implies that the price is being driven up by financial players. even as the real-world consumer who is supposed to burn the fuel is buckling under the pressure. When these factors align, they historically foreshadow demand destruction and a broad equity sell-off. Let's translate this theory into a practical playbook. Rule A. During demand-led climbs, you want to own the producers. A quick way to find them is to screen for exploration and production companies that are trading at less than 6 times their projected cash flow for the next year and have a net debt to capital ratio under 30%, ensuring they're both cheap and financially sound. Rule B. Hedge your cyclical exposure. As you bet on energy producers, consider shorting airline or trucking stocks whose operating profit margins are known to fall below 5% whenever oil tops $80 a barrel. This acts as a kind of portfolio insurance. Rule C. If the oil rally appears to be supply-driven, go long an ETF that tracks Norway's stock market and short an ETF that tracks a vulnerable importer like India or Turkey. Rule D. Use the options market to your advantage. When fear is high and the implied volatility on energy stocks is above 50%, you can sell puts on the integrated majors. This is like selling insurance at an inflated premium. You pocket that premium, and if you're still bullish on a demand recovery, you can roll that cash into long-dated call options to bet on future upside. If this crash course helped you finally connect the dots between the price at the pump and the performance of your portfolio, do us a favor and hit that subscribe button. Next week, we're tearing into the copper market to show you how it telegraphs the cycles in housing and construction. If you have any questions about today's topic, drop them in the comments below. In the end, rising oil can be 3 very different things to the stock market: a crippling tax, a bullish signal, or a powerful steroid. The critical difference is understanding why the price is moving. Is it coming from a supply-side panic or a surge in global demand? To answer that, you have to track the macroeconomic pulse. Watch the positioning data, and always remember that financial markets reward clarity. So the next time you're filling up your tank and find yourself wincing at $3.79 for regular, take a moment and ask yourself, is the global economy accelerating? If the answer is yes, then that pain at the pump might just be the sound of your stocks hitting the afterburners.